One of the most basic questions in Ind AS 103 is whether the event or transaction is a business combination or not. We know one thing. We can apply Ind AS 103 business combinations provided the definition of business combination is getting satisfied. By business combination, we mean any event or any transaction in which the acquirer obtains control over a business. And hence then the main point to be analyzed is whether what we are acquiring is a business or not. We understand business as an integrated set of activities and assets which are capable of giving rise to future economic benefits. When we say business, there has to be presence of inputs and processes. Those inputs and processes are interacting with each other and it is giving rise to output. It is not an issue if the output is not produced right now. Even if output will be produced in future, we can still say that it is a business. In other words, if I have to apply Ind AS 103, it is absolutely necessary that what I am controlling is a business. Every time you will have to do detailed assessment of whether what you are acquiring is a business or not. This is especially true if you are acquiring a group of assets and liabilities. Let us say you are acquiring a group of assets and liabilities. Now, whether the acquisition of group of assets and liabilities constitutes a business or not, a detailed evaluation will be required if I apply Ind AS 103. This is the reason that to make matters slightly simpler, Ind AS 103 is giving us what is known as a concentration test. Concentration test is basically an optional test which you can apply only to judge whether what you are acquiring is simply an asset acquisition. Remember, if it is only an asset acquisition, then I do not have to compute any goodwill or gain on bargain purchase. If it is simply an asset acquisition, whatever is the consideration will be allocated to the assets that you are acquiring in the ratio of their relative fair values on the purchase date. It definitely makes things simpler, and more importantly, an asset acquisition will be outside the scope of Ind AS 103. So instead of doing detailed assessment, detailed evaluation, I can apply the simple concentration test and try to figure out whether it is a business or it is simply an acquisition of assets. First and foremost, remember that this is an optional test. You can directly go for a detailed evaluation of whether what you are acquiring is constituting a business or not. But as I was saying earlier, before I do this detailed evaluation, if a shortcut is available, perhaps I will like to apply that. That's what a concentration test actually does. There are basically two steps in a concentration test. First, you are supposed to calculate the fair value of gross assets that you have acquired. This fair value of the gross assets that you have acquired, you should compare it with the fair value of a single identifiable asset or maybe a group of similar identifiable assets. If you come to the conclusion that the fair value of the gross assets is substantially covering fair value of a particular asset or fair value of a group of similar assets, then we can say it is simply an asset acquisition and not an acquisition of business. So two simple steps. Step number one, determine the fair value of gross assets acquired. And step number two, is the fair value of the gross assets acquired concentrated in the fair value of a single asset or the fair value of a similarly identifiable group of assets? That's what we are supposed to do. As I said, the first step is to determine the fair value of the gross assets acquired. How shall we determine that? Proper guidance is given in Ind AS 103. We just go through the write-up that we have for the concentration test. As I told you earlier, this is an optional test. It is not compulsory to apply it, but to make things simpler, it is advisable to apply this particular test. We are basically trying to assess whether an acquired set of activities and asset is a business or not. Okay. So this is the step number 1. Measure the fair value of gross assets acquired. How will I determine the fair value of the gross assets acquired? Okay. This is the process that you are supposed to follow, right? It will be 1 plus 2 minus 3. Item number 1 is fair value of consideration transferred. That's nothing but your purchase consideration. So we will start with the fair value of consideration transferred. This fair value of the consideration transferred will include the fair value of the non-controlling interest. And in case if you are going for step acquisition, whatever is the investments that you had acquired earlier, find out what is its latest fair value. So fair value of the consideration transferred, including the fair value of the non-controlling interest and fair value of previously held interest. For example, earlier you had acquired 15% of a particular company. Now you are acquiring another 40% of the company. So this is giving us total 55%. Once your holding crosses more than 1/2, only then you will be able to control the business, isn't it? So what you are supposed to do is this 40% that you are acquiring, work out what is the fair value of the consideration that you are transferring for this 40%, right? Total is 55%. That means 45% is the non-controlling interest. Find out what will be the non-controlling interest fair value. And this 15% was acquired in the past. What is its latest fair value? So I should also work out what is the latest fair value. These 3 items are to be added. That is what will give me part 1. Part 2. Part 2 is to be added. Okay. As you can see in this formula, you are supposed to add the second thing. What is the second? Fair value of liabilities assumed. Whatever liabilities that you are acquiring, you should add it to the amount that you have determined in part 1 earlier. But one important thing over here. When you are calculating the fair value of liabilities assumed, you will exclude deferred tax liability. If there is any deferred tax liability that you are acquiring, you should ignore that. Only the other liabilities should be considered at their latest fair values. You may wonder that why will the deferred tax liability be excluded? See, deferred tax liability is created in our books whenever there is a temporary difference. Okay, when you have a taxable temporary difference. Taxable temporary difference is nothing but the difference between the carrying amount of the asset or the liability in the balance sheet and its tax base, right? Now, when I will acquire the selling company, deferred tax liability calculation will be revisited. See, I may be acquiring your company. You are showing a deferred tax liability of 10 lakhs. So let us say I will acquire the deferred tax liability. I'll assume your liability at 10 lakhs. But in my books as a purchasing company, as an acquirer, I will have to recalculate the deferred tax liability. Because now I have to see the entire thing from the merged entities viewpoint. You get my point? So what happens is my own deferred tax liability, your deferred tax liability, both have to be analyzed. And ultimately, I'll have to find out that when I control your entity, what will be the final deferred tax liability. So deferred tax liability is actually a working which will keep on occurring, and that is the reason we are supposed to ignore the deferred tax liability. So when we are saying fair value of the liabilities assumed, we will consider all the liabilities assumed other than deferred tax liability. Deferred tax liability will be recomputed considering now the revised fair values of the assets and the liabilities that are acquired. You know what will happen is you may be showing liability at a particular amount, but when I incorporate that liability in my books, I may incorporate at a slightly different amount. This will create again a taxable temporary difference, and hence the deferred tax liability will be required to be recalculated. So just ignore the deferred tax liability, consider the other liabilities. And from the sum total of 1 and 2, we have to deduct the third item. Cash and cash equivalent and deferred tax assets and goodwill resulting from deferred tax liability. Deduct the cash and cash equivalent. Similarly, if you are ignoring the deferred tax liability, then you should also ignore the deferred tax asset. So deferred tax asset will be deducted. And in case if there is any DTL recognized on goodwill, then even that also should be ignored. This is what will give us the fair value of the gross assets acquired. Once you get the fair value of the gross assets acquired, you will have to compare that with the fair value of a single identifiable asset or the fair value of a group of similarly identifiable assets. So that's the step number 2. Okay. Is substantially all of the fair value of gross assets acquired concentrated in a single identifiable asset or a group of similar identifiable assets? So work out the fair value of the gross assets that you are acquiring. Now go through the individual fair values of the assets that you have acquired. Is the fair value of the gross asset substantially covering the fair value of a single asset or a fair value of a group of similar identifiable assets? If your answer is yes, then it is an asset acquisition. It is not an acquisition of business. If your answer is no, here be careful. If your answer is no, it does not mean it is a business combination. Now you'll have to carry out detailed evaluation. Further evaluation will be necessary before you conclude that it is a business combination. But here if the answer is yes, okay, here if the answer is yes, then it is not a business combination. Then it will turn out to be acquisition of an asset. Another interesting thing is that they say it substantially covers. This word substantially, it has not been clarified in Ind AS 103. They are not giving us a clue that when can we say it is substantial. We have to apply our own judgment. What we will do is we will consider 90% or more as something to be substantial. So if the fair value of the gross assets that you are acquiring is covering at least 90%, at least means 90% or more than 90%, at least 90% of the fair value of a single identifiable asset or the fair value of a group of similar identifiable assets, we will come to the conclusion that it is a, yes, it is a transaction of simply asset acquisition, right? This is single identifiable asset, that is fine, but they are also saying group of similar identifiable assets. For example, when you are acquiring a particular say group of assets, what you are getting in return is, let's say, 5 different industrial units, let's say 5 factory units, and these 5 factory units are located at different places. Now when you see the balance sheet, in the balance sheet all these are nothing but factory buildings, right? So one can say that this is a group of similar identifiable assets. So either you are acquiring only one single factory shade, which will turn out to be a single identifiable asset, or you may be acquiring a number of similar assets, a number of factory shades at different locations. You are acquiring that. I can say it is a group of similar identifiable assets. So if it is substantially covering, understand, if the answer is yes over here, answer is no over here. If yes, it is an asset acquisition. The moment you say it is an asset acquisition, Ind AS 103 will no longer be applicable. But yes, if the answer is no, that does not mean it's a business combination. Further evaluation will be necessary. So they say further assessment is required to conclude that it's a business combination. What will be the further assessment? You will have to identify that what you are acquiring is inputs. You will have to identify what you are acquiring are processes. You will have to also come to the conclusion that there is a constant interaction between the inputs and the processes, and it is generating the output or will generate output in future. So detailed assessment will be necessary to conclude that it's a business combination. But if the concentration test is satisfied, that is, if the answer is yes, no need to do this detailed evaluation. We can very easily, or rather I will say very safely say that yes, it indeed is an asset acquisition. Let's say a question based on this. Entity A holds 20% interest in entity B. Subsequently, entity A acquires further 50% share. You have 20% share, you acquire another 50% share, that means total you have 70% share. So conventionally we can say that your holding is more than one half. And if the holding is more than one half, you are obtaining control. If you say you are obtaining control over a business, then and then only it will become a business combination. Okay. They say by paying rupees 300 crores, the fair value of the assets acquired and the liabilities assumed are as follows. Building 1000 crores, cash and cash equivalent 200 crores, financial liability 800 crores, deferred tax liability. They say deferred tax liability is 150 crores. Fair value of entity B is 400 crores and fair value of the non-controlling interest is 120 crores. Right, you have acquired 70%, that means the remaining 30% is non-controlling interest. They have already given the fair value 120 crores. Fair value of entity A's previously held interest is 80 crores. Determine whether acquisition is an asset acquisition as per concentration test or not. We are supposed to analyze applying the concentration test. Is this an asset acquisition or is it a business combination? Okay. We say evaluation based on concentration test. Let's apply the concentration test. We will have to apply the first step in which we have to work out the fair value of assets acquired. And in that the first item is fair value of consideration transferred. So that's how I will do it. I say fair value of consideration transferred. We are acquiring 50% based on a consideration of 300 crores. So I say 300. To this we should add fair value of non-controlling interest, right? If you say this, I have to take the fair value of consideration transferred, including the fair value of non-controlling interest. They are saying fair value of the non-controlling interest is 120 crores. To this, we should further add fair value of previous investment, right? They say fair value of previous interest held. So we say fair value of previous interest held. They are saying that the fair value of previously held interest is 80 crores. I apply 80 over here. This gives me 500 crores. Okay. To this, we should further add. You check with the concentration test, you should further add fair value of liabilities assumed. Fair value of liabilities. But remember, it should be excluding deferred tax liability. Do not consider deferred tax liability. Here it is. Financial liabilities are there 800 crores, while deferred tax liability of 150 crores is not to be considered. It is 800 over here, total 1300. And now we are supposed to deduct. So you'll say less. You will say less. If I again return back to the concentration test, I am supposed to deduct cash and cash equivalents. And if there are any deferred tax asset, I should be deducting that too. There aren't any over here, but yes, I will deduct cash and cash equivalents. Let me check with the question. Cash and cash equivalents are 200. So this gives me 1100. You may wonder that why are we deducting the cash and cash equivalents? The logic is very simple. Think in this way. Let us say I'm acquiring your company and I pay you 1000 rupees to acquire the company. But once I acquire your company, in return I will get your bank balance. Let us say in your bank's 200 rupees is lying. So please understand. I'm paying you 1000 rupees to acquire your company, and once I acquire the company, I get hold of your bank balance of 200. Effectively, I will think in this way that acquiring your company has not costed me 1000 rupees. Acquiring your company has costed me only 800. Because see, when I pay you 1000 and in return I get cash and cash equivalents of 200, then the gross assets that I am acquiring is only the net amount of 800, isn't it? So that's the reason we deduct the cash and cash equivalents. This gives me fair value of gross assets. Okay, fair value of gross assets. That's what they say here. Fair value of gross assets. You are supposed to calculate the figure that you get in item 1, add to it the figure in item 2, and deduct from that the figure in item 3. And that is what gives me the fair value of the gross assets acquired. Okay. Now look at this question. I'm writing over here for you to compare. I say fair value of gross assets. It is turning out to be 1100. This 1100 you should now compare with assets that you have acquired. If the fair value of the gross assets is substantially covering fair value of any single identifiable asset, or the fair value of similar identifiable assets, group of similar identifiable assets, then we will say that the concentration test is satisfied. And if the concentration test is satisfied, then it will be considered to be an acquisition of assets. Now when I compare 1100 with the assets, now I am having an asset in form of building, and the fair value of the building is 1000 crores. You know what I will do? I will take 1000 and divide that by 1100, and I'll try to express this in percentage. Okay, I say 1000 and divide that by 1100 and try to put it in percentage. It is turning out to be some 90.9%. Approximately I can say 91%. Okay, I take you back to the write-up that we have. We are now applying the second step. Okay, we are applying the second step. Let me remove this. So that you can check with the write-up again. Read this again. See, is substantially all of the fair value of the gross assets acquired is concentrated in single identifiable asset or a group of similar identifiable assets. The fair value of the gross assets that you are acquiring is turning out to be 1100, that we know. And as far as building is considered, its fair value is 1000. don't you feel that the fair value of the gross assets acquired is substantially concentrated in a single identifiable asset? The word substantially is not defined, but we understand that as 90% or more. In our case, it is turning out to be 90.9% or approximately 91%. It just means that the concentration taste is getting satisfied. This is not a business combination. This is simply asset acquisition. So we get the fair value of the gross assets, and now we say fair value of gross assets acquired is concentrated, right? Is concentrated in single identifiable asset because it substantially covers 90% or more of the fair value of building acquired. %90 or more, you can show your calculation. Fair value of building divided by fair value of gross assets into 100, that is 1000 divided by 1100, that is 90.9%, right? If you are still writing, you can just pause the video here and complete it. We say concentration taste is fulfilled. Concentration taste is fulfilled. The given case is of asset acquisition. The given case is of asset acquisition. That will be the end of our solution.